Hello, welcome to Trading Central February Technical Outlook. I'm Remy Gossens, Head of Technical Analysis, and with our analyst team over the next 15 minutes, we are going to review a one-month technical scenario on key assets. Connected with us, we have Gary Christie from North America Research, based in Ottawa. Hello, Gary.
Hello.
We also have Nicolas Suiffier, Head of European Research, based in Paris, France. Hello, Nicolas.
Hello, everyone.
And also based in Paris, we have Christophe Chevalier, FX specialist. Hello, Christophe.
Hello, everyone.
Hello, Christophe. With them, we will detail our 1 month scenario on key assets. With February equity market sharp correction, we hope you will find interesting our analysis on the S&P 500 and also on the STOXX 600. On the forex market was also affected by the recent increase in volatility, and we will discuss how it affected our US dollar technical outlook. And we will finish this review with our current scenario on commodities, starting with the current correction in place on crude oil, and finishing with the gold scenario that is currently bullish above the key support at 1,300. Now let's start with the US equity market with Gary Christie from North American Research Desk. Gary, your turn.
Thank you, Remy. Just having a look at the SPX weekly. Some interesting things are happening right now with the US markets. So I want to start off with a weekly chart of the SPX, S&P 500. This is a 5-day weekly chart with weekly bars. What we can see is we still remain supported by a rising trend line in place since the beginning of 2016 with this nice rising trend line and the 50-week moving average acting as support. So 2540 is our stop. That was near the lows that we tested with this massive pullback we recently had in the SPX. So we are breaking above that 20-week today right now. It would be interesting if we close above there on a weekly chart by Friday. We'll see. But we are rebounding, and we still like the uptrend overall long-term in the SPX. As we're looking at the RSI, we never broke really below that 50 level. That just means to us that that uptrend is still intact, even though there's been some increased volatility. But we do remain bullish above 2540. That is our pivot point, our stop loss, with targets of the most recent high at 2872 and ultimately 2990 in extension. That is a Fibonacci extension from this trend breakout that we had in October when we were chopping around for quite some time, and then we made a low and started just off to the races. So for now, we like the weekly picture, but a different story when it comes into a daily chart. And we are bearish, and I'll show you why right now. Here's a daily chart of the SPX. We can see the first signal when we broke down was when we broke below that 20-day moving average in red at the 2810 level. And then we continued lower when we broke below the 50-day moving average and this rising trend line in place since back in September of last year. So although we are rebounding, the US does remain bearish, as we like to maintain discipline and wait for confirmation of a new uptrend. So for now, we may see some tests at 2728. That's our stop loss and a major resistance level, as this is also the 50-day moving average. So when we broke down, we actually targeted the 200-day moving average in green here at 2540. We did reach that. Strong rebound, nice bullish hammer candlestick right above that lower Bollinger Band. And we also tested the 50-day on the upside. It failed, and we broke down again. So really here, we're expecting further downside pressure towards 2540 and a retest of that 200-day moving average. Only if we break 2728, which would be a break of the 50-day moving average to the upside, we would change our view to bullish with targets of 2810, which is the first breakdown resistance area we had, and 2872, the ultimate high, which is our first target on a weekly chart. So our stop loss on a weekly is 25.40, which is the 200-day on a daily chart. So everything is in sync here with our trading plan. And we're going to hope for a test of 25.40 before we get bullish again. And for now, just expect some choppy price action with some, with a range bound between 25.40 and 27.28 until we get a confirmation of a daily close above 27.28 short term. So long term, we remain bullish, of course, on the SPX. The trend is still intact. Just short term, expect some volatility, some choppy price action, and a bearish bias towards that 200-day until we get a confirmation of a break. That's it for now on the U.S. markets. I'll hand it over to Nicholas, who's the head of European research, for an outlook on the European markets. Nicholas?
Okay, thank you, Gary. So let's have a look now at the technical picture in Europe. So European equity markets have fallen sharply during the last 2 weeks, as you can see in this chart of the STOXX 600 index. So the index price has validated what we call a rising wedge pattern, as you can see here, which is a reversal downtrend signal, downtrend pattern, and prices have almost reached the theoretical target of the pattern, which is set around the base of the pattern around 366. So this is the dotted line, as you can see here. So that's why on a daily chart, so let me just switch to a daily chart. On a daily chart, we expect only limited downside towards the key support threshold around 366, as you can see here. This is the blue line. So as a reminder, this is the theoretical target of the falling wedge, of the rising wedge pattern. So that's why we think that the downward potential should be limited on a very short-term perspective. And if you have a look at the daily RSI, as you can see here, the daily RSI broke above the 30% level, which means that we could see some stabilization in the coming weeks. So that's why the most likely scenario, according to us, on a very short-term perspective, is a potential retest of this key support threshold at 366 before prices can post a technical rebound toward Fibonacci retracement level around 381.40, which corresponds to the 38.2% Fibonacci retracement level of the last bearish acceleration. And in extension, the 50% Fibonacci level toward 385. Alternatively, a break below this key support at 366 would open the way to a further decline to more downward pressure towards the next key support area, congestion area, towards 356, 351. As you can see here, this is the red line. So to sum up, we expect a kind of stabilization in the coming weeks on the STOXX 600, as long as prices are holding above this key support threshold around 366. A slight recovery is likely, is the most likely scenario, according to us, towards Fibonacci retracement level around 381, 385. Okay, so that's it for Europe. Let's now switch to the Forex market with Christophe.
Let's start the Forex analysis with the euro dollar, which remains on the upside. Since it broke above its 2017 top at 129 in early January here. We can also notice that the pair remains supported by its rising 50 days moving average, you can see here in blue. So further advance is likely on this pair above 120.90 with first targets at 126 and a second one set at 129 in extension. Only a break below this very strong horizontal support and a firmer resistance at 120.90 will turn the outlook to bearish if we break below this strong horizontal support, with alternative targets set at 119.15 January bottom, and then 117 in extension, which is a horizontal support. Let's now cross the channel to have a look at the British pound versus the US dollar. We can see that the outlook on this pair looks the same as the euro dollar. as it remains above its former 2017 top at 146.15, which now behaves as a support following the polar weighting principle. It remains as well supported by its rising 50 days moving average in blue. So the current pullback is expected to face a nice support area, so at 136.15 and the 50 period moving average. So rebound is likely on this support, with a first target set at the January top at 133.45 and then 145.60 in extension. If we break below 136.15, the outlook, the short-term outlook, will turn to bearish. The first alternative target set at the horizontal support and overlap at 133, and then the strong horizontal support at 130.20 in extension. On US dollar versus Japanese yen, we can notice that the pair has just broken below a very strong horizontal support at 107.30, which was the previous September bottom, but also the lower boundary of a wide trading range in place for a year between 107.30 and 114.75 on the top. So we are currently breaking below this very strong horizontal support. So further weakness is likely towards the horizontal support at 106 at first, and then 104.20 in extension. We will turn to bullish only in case of a break above the strong horizontal support, horizontal resistance and overlap at 111, which is also the 50 days moving average here in blue. If we break above this horizontal resistance, a rebound will be likely towards the upper boundary of the previous trading range, around 113.40 and 114.75 in extension, which is November top, but also the top of the horizontal trading range. That is all on Forex. We can now switch to commodities.
So thank you, Christophe. Let's start with the current situation on crude oil. Well, we have seen a downside breakout of a rising trend line that was in place since early September. So there is currently a correction that is in place, especially since the downside breakout of the 50-day moving average that was acting as a support since September also. So what are the next targets? But the next support area are set at 55.8, which is a December bottom, but mainly the 50 is a 50% retracement of the rise of the up move from June to January, and we can definitely expect that the current correction movement will stop around this 54 support area. Now let's have a look at what is happening on gold prices. Well, we have seen a pullback toward the key support area, which is set at 1,305. That's a polarity area, a former resistance that is now acting as a support, and that is definitely expected to act and to help for a rebound in the coming weeks. You can also notice that there is a former declining trend line that was in place on the RSI, and we have seen a kind of pullback on this area, and now we can see a bullish movement that is happening on precious metals. So that's all for commodities. I would like to remind you our current view on different assets.
Yes.
So our current view is a correction currently on the US indices, especially on the S&P 500. We expect a limited upside on the STOXX 600. in Europe. We are also looking for a correction on the US dollar. So this means that we are looking for further advance on euro against US dollar and GBP against USD, and also a correction movement on the USD against Japanese yen. On crude oil, the downside potential is limited to the 54 key support area. And on the opposite, on gold prices, we can expect further advance as long as prices remain above the 1,305 key support level. Our next webinar will happen on March 14 at 9 a.m. Same time next month. Thank you for watching. Bye-bye.
Bye.